Welcome to our deep dive into the wild, wild world of corporate risk management.
Wild, wild world. Love it.
We're going to be looking at some excerpts from a corporate finance textbook
Okay.
and kind of focusing on this one chapter that is all about how companies handle risk.
All right.
But we're not going to just define all the terms.
Right.
We really want to understand why companies make certain choices and how those choices impact their value, their ability to succeed, all that good stuff.
What's really cool is that risk management, it's not just about avoiding losses. It's a lot about finding ways to take on more risk.
Oh, interesting.
But intelligently, in pursuit of higher returns.
So you're saying, it's okay to take risks if you know what you're doing.
Yeah. You got to be smart about it.
I like that. And think about it, in your own life, you probably do this all the time. You buy insurance for your car.
Right.
But maybe you decide, you know what, I'm not going to get that extended warranty on this new gadget.
Exactly.
So companies face these same kinds of decisions. They do, just on a much, much larger scale.
Much bigger stakes.
Yeah, absolutely. So our source kind of highlights how entrepreneurs and managers, they inherently accept risk.
Yeah.
It's just the price of doing business.
It comes with the territory.
But the key is managing it strategically, and that's where it gets really, I think, interesting for us.
That's where the fun begins.
So let's start with something that feels a little bit familiar, I guess. Insurance.
Okay.
It seems pretty straightforward.
Right.
You pay a premium to protect yourself against a potential loss.
Makes sense.
But our source suggests it's not always so simple.
It can get a bit more nuanced.
Yeah.
Imagine an oil refinery. They face this tiny, tiny chance of a fire, like 0.02%.
Wow, that's small.
But if that fire happens,
Oh, no.
it could cause a $150 million loss.
Oh, wow.
So the expected loss is small, but the potential downside, huge.
That makes sense.
Now, in a perfectly efficient market, insurance for that scenario, it would have, theoretically, zero net present value.
Wait, so why would you even bother?
Yeah.
If it's basically a wash financially, why spend any money on it?
That's the question. Because markets are rarely perfect.
Ah, okay.
So there are all these hidden costs and benefits that insurance can bring. For example, insurance, it's a lifesaver when it comes to avoiding bankruptcy. The textbook uses this great example of an airline.
Okay.
If there's a major accident, they're not just facing the cost of the accident.
Right.
You've also got potential financial distress costs on top of that.
Okay.
So that could mean having to raise capital quickly at really unfavorable terms,
Right.
maybe even facing lawsuits.
Okay.
Insurance, it provides this crucial cushion against those ripple effects.
So it's not just about the payout, it's about protecting the long-term stability of the company.
You got it. And think about how expensive it is for a company to issue new stock,
Oh.
to raise cash after a big loss. Insurance just provides that cash on hand, lets them avoid those costs.
Okay.
Taxes play a role too.
Oh, interesting. Oh,
Our
sure.
source gives a really clever example of an almond grower.
Okay.
So if their crop fails, they're suddenly in a lower tax bracket.
Oh.
So they buy insurance when their tax rate is higher,
Okay.
and that lets them shift income to that lower tax period.
Oh, so it's a little bit of a tax benefit.
Exactly. Creates a net tax benefit.
That's a pretty slick move, I gotta say.
Yeah, it's a smart strategy.
So companies really have to think about insurance like a chess game, considering all these angles.
Absolutely.
But I'm guessing there are times when it's just not the best move.
For sure. You got to be aware of things like adverse selection
Okay.
and moral hazard.
I've heard of moral hazard.
Think about it from the insurance company's perspective.
Okay, yeah.
If they suspect a company's downplaying their risk,
Right.
they're going to charge higher premiums.
Okay.
That's adverse selection in action.
Makes sense, yeah. They don't want to be left holding the bag.
Exactly. Then there's moral hazard.
Right.
If a company is fully insured,
Yeah.
are they going to be as careful?
Probably not.
Right. Maybe a little less diligent about safety procedures, risk mitigation.
Yeah. You get a little bit lazy.
They know insurance will cover any losses.
It's kind of like if you have that safety net, you're a little bit less cautious.
That's it.
Interesting.
That's why you have things like deductibles.
Oh, right. What?
Limits. It forces the company to retain some skin in the game.
Yeah, that makes sense. Okay, but here's something I find counterintuitive. Our source mentions that companies in financial trouble are actually less likely to buy insurance.
That's a good point.
Why would that be?
It's a bit strange, right?
Yeah.
But a company in distress, they need cash now.
Right.
And paradoxically, if things go really bad
Uh-huh.
and they end up in bankruptcy,
Yeah.
the losses might actually benefit their debt holders.
Oh, wow.
It's about who ends up taking the financial hit.
So the decision to buy insurance, it's really tied into the company's overall
Everything's connected to.
financial health, their strategy. Yeah, that's way more complex than I initially thought.
It's a big puzzle.
Let's shift gears for a second and talk about another big risk, volatile commodity prices.
All right?
What if the key ingredient for your product, suddenly it's super expensive?
Supply chain woes.
Oh, yeah, that's going to be a nightmare for business owners.
Definitely keeps you up at night. The textbook uses a great example, Southwest Airlines.
Okay.
Back in the early 2000s, when oil prices were skyrocketing, Southwest had locked in their fuel prices. $23 a barrel.
Wow.
They used something called a futures contract, and it saved them billions.
Wow, that's serious foresight.
Yeah, smart move.
But I'm guessing it's not always a win.
You're right. There were times when oil prices dipped below that locked-in price,
Right.
meaning they could have bought it cheaper.
On the open market.
It's always a trade-off. Certainty versus the potential to save.
So how do companies navigate these unpredictable commodity price swings? Can they just buy a ton of the raw material?
Stockpile it.
Yeah, and store it.
Well, storage works for some things.
Okay.
But imagine trying to store enough jet fuel for an entire airline.
Yeah, that's not very feasible.
The costs would be astronomical.
You can't just have barrels of oil in your basement.
Not unless you have a really big basement. So that's where things like futures contracts come in.
Okay.
It's basically a way for companies to buy and sell commitments
Okay.
to trade commodities at a specific price, even years in advance.
So it's like a financial time machine.
Yeah, you could say that.
They can lock in prices for the future.
Exactly. Manage that uncertainty.
Wow. The textbook actually has a chart. It's crude oil futures prices from February 2022.
Oh, wow.
And it shows prices all the way up to 2030, locked in.
Long-term planning.
Yeah. But of course, there are risks.
Always risks.
So what are some of the downsides? I'm all ears.
Well, one big one is, what if the other party can't fulfill their end of the deal?
Right. Okay, so you're locked in, and then they back out.
Yeah, but futures markets are pretty clever. They have a way to mitigate that risk.
Okay. Tell me more.
It's all about margin and daily settlement.
Oh, okay.
So when you enter a futures contract,
Yeah.
you got to put up collateral. It's called margin.
Okay.
It guarantees your side of the deal.
Mm-hmm.
And then each day, gains and losses, they're settled
Okay.
based on the changes in the futures price.
Oh, interesting. So everyday things are kind of trued up.
It's like keeping score in a game, but it's a financial game.
So if the price moves against you, you got to pony up more cash to cover your position.
Exactly. But this system also introduces its own risk.
Okay.
The book highlights this company, Metal Gesellschaft.
Mm-hmm.
They actually went bust.
Oh.
They couldn't cover their losses when oil prices dropped.
Oh,
They
wow.
ran out of cash to meet those margin calls.
So it's a high-stakes poker game. You really got to be prepared for big swings.
High risk, high reward.
Yeah, futures contracts can be powerful tools,
Powerful but risky.
but definitely not for the faint of heart. That brings us to another major risk area
Oh, yeah.
for a lot of companies, currency exchange rates.
Ah, yes. The currency casino.
So let's say you import or export goods.
Right.
Sudden shift in currency values.
Wipes out your profits.
It's a risk that I think a lot of us don't think about on a day-to-day basis.
Yeah, it's easy to forget.
But for companies operating in a global marketplace, it's a huge factor.
It's a huge factor.
The textbook uses this example of Manzini Cyclery.
Okay.
They import bike parts from Italy.
Makes sense.
Back in December 2002,
Right.
they ordered parts worth $500,000.
Okay.
And at that time, the dollar and euro, they were trading at parity.
1-to-1.
But just a year later,
Uh-oh.
the euro, it had strengthened so much,
Yeah.
Manzini ended up paying a huge premium for those parts.
Ouch. That's a tough break.
That's a nasty surprise. So what can companies like that do to protect themselves from those currency fluctuations?
Yeah. Do they just cross their fingers?
Yeah, are they just hoping for the best?
Well, they could,
Okay.
but that's not exactly a sound risk management strategy.
No, probably not.
Thankfully, there are some more sophisticated tools available.
Okay.
Let's talk about those.
Yeah, let's hear them. What are some ways that companies can manage that currency exchange risk?
All right. One way is to use something called a forward contract.
Okay.
It's basically an agreement with the bank
Mm-hmm.
to exchange currencies
Okay.
at a predetermined rate
Okay.
on a specific date in the future.
Okay.
So in Manzini's case,
Yeah.
they could have locked in an exchange rate
Right.
that would have protected them if the euro strengthened.
So it's kind of like prepaying for their parts in euros,
Yeah.
but using today's exchange rate
Exactly.
to avoid that uncertainty.
Right. You eliminate the uncertainty.
But what if the euro had weakened instead?
Yeah.
Would they be stuck paying more?
That's the trade-off.
Right. Yeah.
You could miss out on potential gains if the rate moves in your favor.
So it's kind of like buying insurance. You're paying for that peace of mind.
Exactly.
But where does the risk actually go
Yeah.
when a company uses a forward contract like that?
So initially, the bank takes on the risk,
Okay.
but banks are really good at managing risk.
Right.
They'll usually find another party
Okay.
who wants to do the opposite trade.
Oh, okay.
So they offset the risk,
Okay.
and they earn fees from both sides.
It's like a financial matchmaking service
So like,
for currency exchange.
yeah,
Banks are like the ultimate deal makers.
that's a great way to put it.
So this whole process actually kind of helps us understand how those forward exchange rates are determined.
Right.
There's this concept called covered interest parity,
Okay.
which links exchange rates and interest rates.
Interesting.
It's like a financial balancing act to make sure these contracts are priced fairly.
Makes sense.
Give me the layman's version, though.
Okay, so basically, if interest rates are different between two countries,
Mm-hmm.
investors, they're tempted to borrow money in the country with a lower rate
Right. Okay.
and then invest it in the country with the higher rate.
Okay.
Yeah.
So you go where the returns are higher.
It's like shopping around for the best savings account.
Yeah, exactly. On a global scale. But I'm guessing it's not that simple.
Of course not.
There's some risk.
Always a risk.
So what is it?
The risk is that the currency
Okay.
in that higher interest rate country
Right.
could weaken
Yeah.
during that investment period.
And then you lose everything.
Well, you could wipe out your gains.
Okay.
So they use a forward contract to protect themselves, to lock in that exchange rate.
Okay, that makes sense. So that forward rate, it has to take into account
It does.
those interest rate differences.
It's all connected.
Otherwise, everyone would just pile into higher yielding currency.
Exactly. The market finds a balance.
And this is where it gets really interesting.
Okay, tell me.
Our source mentions that during the 2008 financial crisis,
Mm-hmm.
these seemingly risk-free currency trades,
Okay.
where you borrow in one currency,
Right.
convert it to another,
Mhm.
invest it at a higher interest rate, and then use that forward contract
Yep.
to lock in the exchange rate back, they started showing these huge potential profits.
Oh, wow.
Risk-free, but with huge profits. That sounds too good to be true.
Yeah. What's the catch?
Yeah, how is that even possible?
Well, it turns out what was considered risk-free before the crisis
Yeah.
suddenly wasn't.
Oh, okay.
The risk hadn't gone away.
Okay.
It had just shifted to a different place.
Okay.
Counterparty risk.
Counterparty risk. Remind me what that is again.
It's the risk
Okay.
that the other party in a financial transaction
Yeah.
won't be able to fulfill their obligations.
Okay.
So before the crisis,
Yeah.
everyone assumed banks, they were basically risk-free counterparties.
Right.
But when the financial system started to crumble,
Mm-hmm.
suddenly the idea of a bank failing
Oh, yeah.
wasn't so far-fetched.
Right.
So even though the interest rate
Yeah.
and the exchange rate math still worked out,
Mm-hmm.
there was this underlying risk
Yeah.
that the whole thing could blow up
Right.
if your counterparty went belly up.
So even though it looked good on paper,
Exactly.
there was that risk that wasn't being fully accounted for.
Right.
It's a good reminder that in finance, risks can be lurking in unexpected places.
It lurks everywhere.
Even in those seemingly risk-free trades.
Be careful out there. And what's fascinating is these opportunities
Yeah.
for those outsized profits, they stuck around
Oh, really?
even after the crisis.
Wow.
Partly because of new regulations
Okay.
that made it more expensive for banks
Yeah.
to engage in these arbitrage trades.
So the market wasn't as efficient
Not quite.
as economic theory might suggest.
The real world is messy.
Free money is never truly free.
There's always a cost.
Yeah. Okay. So we've covered forward contracts. They're great for locking in exchange rates.
Right.
But what about situations where a company's not sure if a transaction's even going to happen?
Oh, good point.
Like, let's say they're negotiating a big deal
Okay.
with an overseas company,
Mm-hmm.
but there's a chance it might fall through.
It's a possibility.
Would they use a forward contract then?
Not necessarily in those cases.
Okay.
They might turn to something called currency options.
Options, okay.
Yeah.
I remember we talked about those when we were doing the deep dive into stock investing.
Yeah.
They give you the right, but not the obligation
Exactly.
to buy or sell something at a certain price.
Right.
So how does that work with currencies?
It's very similar.
Okay.
A currency option gives the holder the right, but not the obligation, to exchange currencies at a preset exchange rate.
So instead of locking in a rate with a forward contract,
Yeah.
they can buy a call option,
Right.
which acts like a price ceiling.
Unlike insurance, right?
Yeah. So they're protected if the currency jumps up in value,
Right.
but they can still benefit if it goes down.
You got it.
That sounds pretty handy,
It offers flexibility.
but it comes at a cost.
There's always a cost.
You got to pay a premium for that option, just like you would for any insurance.
Exactly.
So how do they decide
Yeah.
when to use an option versus a forward contract?
That's a great question. It really depends on their risk tolerance
Okay.
and the specifics of the situation.
Okay.
So if they're fairly certain the transaction's going to go through,
Yeah.
a forward contract might be the simpler, more cost-effective choice.
Okay.
But if there's a lot of uncertainty,
Right.
options provide that extra flexibility.
I'm starting to get a sense of how complex this all is.
Yeah.
There's so many moving parts, so many different tools to consider.
It's this whole toolkit.
It really is, yeah. Companies have to pick the right tool for the job.
Absolutely.
And one of the examples in the textbook really highlights this.
Yeah.
It talks about this company, ICTV.
Yeah.
They were developing broadband TV technology,
Right.
and they had this deal in place
Okay.
with Vodafone New Zealand.
Oh, wait.
But there was a chance Vodafone might cancel.
Uh-oh.
So using a forward contract to hedge their currency risk would have been risky
Risky, yeah.
because they might have ended up exchanging currency they didn't even need.
Exactly.
So options, it provides that safety net.
Options to the rescue.
They could buy a put option,
Right.
which gives them the right to sell those New Zealand dollars at a certain rate,
Okay.
protecting them if the currency weakens.
Remove.
And the deal goes through.
They're covered both ways.
Yeah, they're covered on both fronts, the currency risk and the risk of the deal falling apart.
Exactly.
That's smart. But how are these currency options actually priced?
Yeah, that's a good question.
It seems like it would be tricky
Yeah.
to put a value on that kind of flexibility.
It is complex.
Okay.
But luckily, there are sophisticated models that can determine the fair price of an option.
Okay.
Remember when we were talking about stock options?
Yeah.
And those dynamic trading strategies?
Yeah.
We touched on the Black-Scholes model.
Vaguely. I remember it involved some serious financial wizardry.
It does. But it turns out you can use the same model to price currency options.
Oh, wow.
You just swap out the stock price
Okay.
for the exchange rate.
So the underlying principles are the same.
The math is the same.
It's just applied to a different
A
asset.
different context.
Okay. And just like with stocks, you can even calculate the implied volatility of
Yes.
the exchange rate.
It tells you how much the market expects it to fluctuate.
Okay. I'm starting to feel like I could hold my own in a conversation about currency risk management.
You're giving it.
But I know there are even more types of risk
Oh, yeah.
that companies have to grapple with.
Plenty more.
So what else is on the agenda? What should we talk about next?
Let's talk about interest rate risk. It impacts pretty much every company that borrows money.
Interest rates. Yeah. It's a roller coaster.
They can be a real headache.
Yeah.
I know, even in my own life, I get a little nervous when I hear the feds talking about raising rates.
I feel that.
I can only imagine what it's like for businesses
Oh, yeah.
that have millions, billions of dollars on the line.
It can make or break you.
So when interest rates rise,
Yeah,
borrowing costs go up.
they do.
That can squeeze a company's profits.
Less money to go around.
And for companies with a lot of long-term debt,
Mm.
like bonds or leases,
All right.
a rise in rates can actually lower the value of those assets,
That's right.
which can impact their overall financial health.
It's all connected.
So it's a double-edged sword.
Yeah.
And for companies that really depend on that borrowed money,
Mm-hmm.
even small changes in rates can have a big impact on their bottom line.
It's a big deal. So how do they even begin to manage this risk?
Yeah, how do they even approach it? Well, we got to go back to a concept we've talked about before.
Okay.
Duration.
Duration. Okay.
Yeah.
That's how we measure the sensitivity
Right.
of a bond's price to changes in interest rates.
Exactly.
The longer the maturity of a bond,
Yeah.
the more volatile its price
They're sensitive.
when rates move.
That's right.
But how do we apply that
Yeah.
to an entire company
That's the question.
with all these different assets and liabilities on the balance sheet?
Right. It's not just one big bond.
Yeah.
Well, think of a company's balance sheet.
Okay.
Like it's a portfolio
Okay.
of assets and liabilities.
Okay.
And each of those items has its own duration,
Okay.
just like with a bond portfolio.
Yeah.
We can calculate a weighted average duration
Okay.
for the whole company.
So it's like taking the temperature
Yeah.
of the company's overall sensitivity to interest rate changes.
Exactly.
The higher the duration,
Yeah.
the more vulnerable they are to those
The
fluctuations.
more risk.
And this leads to a really important concept: duration mismatch.
Duration mismatch.
That sounds ominous. What exactly does that mean?
It means the duration of a company's assets and the duration of its liabilities, they're out of sync.
Okay.
The textbook uses a great example to illustrate this. Savings and loan institutions,
Okay.
or S&Ls,
SNL.
they typically have a lot of long-term assets like mortgages
Right.
and a lot of short-term liabilities like deposits.
Ah, I see where this is going.
So if interest rates suddenly jump up,
Yeah.
the value of those long-term mortgages, it plummets.
Okay.
But the cost of those short-term deposits,
Yeah.
it doesn't change as quickly.
Right.
That creates a problem.
Big problem. Yeah.
Exactly.
Yeah.
It's a classic duration mismatch.
Yeah.
Our source actually walks through a detailed example with Acorn Savings and Loan.
Okay.
And the numbers are pretty eye-opening.
Really?
Acorn has this huge gap between the duration of their assets and their liabilities.
Okay.
And it makes them super vulnerable to interest rate hikes.
I see.
Even a small increase in rates could wipe out a big chunk of their equity.
So if you're running a company like Acorn, what can you do to fix this mismatch?
Yeah.
Reduce your exposure?
Yeah.
Could you just sell off some of those long-term mortgages
You could.
just to shorten the duration of your assets?
The textbook even provides a formula
Oh, wow.
for calculating exactly how much you need to sell
Okay.
to achieve a certain duration target.
Okay.
But for many companies, especially ones in the lending business,
Yeah.
selling off core assets
Right.
like mortgages.
You can't just tell a baker to stop selling bread.
Exactly. It's not really a sustainable strategy.
Right. It defeats the purpose of their business.
Right. So what other options do they have?
Yeah, what else could they do? Could they issue more long-term debt
They could.
just to lengthen the duration of their liabilities?
That's a possibility.
Yeah.
But it might not always be the most cost-effective
Right.
or strategic approach. That's where a really powerful tool comes in. Interest rate swaps.
Swaps. Okay, so we talked about those earlier
Yeah.
when we were discussing how companies manage currency risk.
We did.
Remind me how those work.
Okay, so in an interest rate swap,
Okay.
two parties agree to exchange interest payments
Okay.
based on a notional principal amount.
Mm-hmm.
One party agrees to pay a fixed interest rate.
Right.
The other agrees to pay a floating rate, usually tied to a benchmark like LIBOR.
LIBOR. Okay, that rings a bell. What is that again?
It stands for the London Interbank Offered Rate.
Okay.
It's a widely used benchmark
Okay.
for short-term interest rates.
So it's kind of like a constantly changing barometer
Yeah,
of how much it costs banks to borrow from each other.
exactly.
And companies can use these swaps to essentially bet
You could say that.
on whether rates are going up or down.
That's one way to think about it.
Okay.
But what's really powerful about swaps is that they allow companies to separate interest rate risk from credit risk.
Oh, interesting. Okay.
The textbook gives a great example of Alloy Cutting Corporation.
Okay.
They need cash, but they have bad credit.
Oh, that's a tough spot.
So they're facing high borrowing costs.
Right.
So here's what they do.
Okay.
They borrow money short-term when rates are generally lower,
Okay.
and then they enter into a swap
Okay.
where they pay a fixed rate and receive a floating rate.
Okay.
Now, as their credit improves over time, that spread between their borrowing costs and the fixed rate on the swap, it narrows.
Oh.
They actually save money.
So they're using the swap to lock in a lower rate than they could get on their own.
Exactly.
And then as their creditworthiness improves, they actually benefit from that.
It's a win-win.
That's pretty clever.
It is. And remember Acorn S&L
Yeah.
with that duration mismatch problem.
Yeah.
Swaps can help them too.
Okay.
They enter into a swap where they pay a fixed rate and receive a floating rate.
Okay.
They effectively reduce the duration of their liabilities without having to sell off those long-term mortgages.
So they're not getting rid of their core business.
Exactly. It's like a financial magic trick.
So swaps are like the ultimate financial tool.
Incredibly versatile.
It's like financial duct tape.
You got it. You can use it for
You
everything.
can fix all sorts of problems with these things.
The textbook even gives an example of how to calculate the right size swap to achieve a specific duration target.
So it's all about finding that sweet spot
It is
where the duration of your assets and liabilities are aligned,
in sync.
and that reduces your exposure to those interest rate swings.
Exactly. Risk management in action.
This is all fascinating stuff.
It is pretty cool.
But I have to admit, it's also a little overwhelming.
I get it.
There are so many different types of risk.
There are.
So many different ways to manage them.
It's a complex world.
It seems like risk management is an ongoing process.
It is.
Not just a one-time fix.
It's a journey, not a destination.
Yeah, and even with all these sophisticated tools,
Yeah.
there are limitations.
For sure.
Duration matching, for example.
Right.
It kind of assumes that interest rates move in a predictable way.
It makes assumptions.
But in reality, it's not so simple.
Real world's messy.
The yield curve,
Yeah.
that relationship between short-term and long-term rates,
Right.
it can twist and shift in all sorts of unexpected ways.
You never know what's going to happen.
So it's not like all interest rates move up or down in perfect lockstep.
Not at all.
And I imagine that different types of assets and liabilities, they can react differently to those changes.
They do.
Even if they technically have the same duration.
That's right.
So duration matching, it's a good starting point.
A good framework.
But it's not a foolproof solution.
Not at all.
Companies need to be constantly monitoring their risk exposure, adjusting their strategies, being prepared for the unexpected.
Always be prepared.
So what's the one thing our listeners should remember
Okay.
about corporate risk management?
I think the biggest takeaway is that risk management, it's not just about avoiding losses.
Okay.
It's about understanding and managing uncertainty.
Okay.
So companies can make strategic decisions that maximize their chance of success.
So it's really about finding that balance between risk and reward.
Exactly. You said it perfectly.
So the next time you hear about a company making a big financial move, whether it's acquiring another company,
Yeah.
issuing new debt, investing in a new project,
Right.
think about the risks they might be considering behind the scenes.
Yeah.
They're probably using some of the tools and techniques we've discussed today
Hopefully.
to navigate those choppy financial waters.
Smooth sailing.
Exactly. Well, this has been a fascinating deep dive.
It has.
And remember, we've only just scratched the surface.
There's always more to learn.
That's the beauty of a deep dive.
It is.
It sparks our curiosity,
Curiosity is key.
gives us a starting point for further exploration.
Keep exploring.
So until next time, keep learning, keep exploring.
And happy diving.
Happy diving.